Wanted to take a look at the retail sector today. The stock market is selling off sharply. We saw information come out of Walmart. Walmart stock is down some 10% on forward guidance. Now, when you take a look at Walmart stock and you consider where they are, who they are, looking at the retail sector, this is a sector that I believe is going to take a hit. ETFs for the retail sector, XRT ETF, of course, is the main one. There are sort of subsectors and different ETFs that kind of look at that. But I wanted to specifically look at the retail sector, and XRT ETF is that sector. This is a sector that has kind of struggled. They don't perform extremely well. The discretionary sector does perform very well. However, XRT ETF lags considerably. Now that we're seeing a big selling in Walmart stock, XRT ETF is moving lower. And this is one that if you are, like myself, someone who plays sectors, someone who plays ETFs, likes to play options, XRT ETF is one that I think is going to take a big hit based on the tariffs and its effect on the U.S. economy. On the one hand, we've got inflation that the Federal Reserve needs to deal with. These tariffs are going to push prices higher. The Federal Reserve is going to have to keep interest rates higher for some period of time. Because of that, economic expansion is going to be restricted. So we are starting to see a wake-up call in retail stocks, in the retail sector. And from that, XRT ETF is going to definitely be sliding lower. And this is one that I'm trying to eye up. How can I put in a trade on XRT ETF to take advantage of a downside move? Let's jump in and I'll break down some charts on XRT ETF. Want to start off looking at Walmart stock right here. As you can see, big sell-off today. Forward guidance was the reason. Now, Walmart themselves hit their numbers today, but they're looking into the future. 10% tariffs. How does that really affect the economy? This is a tax. And when you look at Walmart and Walmart stock, their margins are razor thin. So if there's an increase of 10% from products that they buy out of China, which there is now, they pass that on entirely to the consumer. Walmart is going to buy those products, manufacturers in China, throw them up on the shelves in their stores, and then pass that cost to the consumers, Walmart's customers. Okay, great. That might play out to 2.5%, 5%, 6%, maybe 7%, depending on the item. Not every item is made in China, so not every item being sold inside of Walmart is affected by this, but there is going to be an effect. That is a tax. And Walmart, because of their margins being as thin as they are, they're going to pass that tax, that cost to the consumer. This is going to happen across the board with all retailers. This is just sort of the wake-up call when you look at Walmart stock, when you consider retail in general. So this is the SPDR S&P Retail ETF, XRT ETF. And whereas other sectors, discretionary sector, for example, has moved higher over the past couple years, XRT ETF is all retailers. And these haven't really done extremely well, sort of lagged entirely. And because of that, I think they're going to do quite poorly going forward with these tariffs. We start with the economy. With me, anybody who does not follow me, if you're just finding this video, I don't care about individual stocks to start. What I ask the question is, how's the economy? What's going on with the economy? Is the economy expanding? And if so, which stock would expand within each sector at maybe a pace that's higher than the broad economy? In this case, we're looking at a contraction of the economy. The Federal Reserve has to keep interest rates elevated for longer. The reason why is real simple. We have inflation. We just got CPI data points that moved higher above the 3% year-over-year change. Federal Reserve is tracking for or targeting 2%. All of a sudden we get data points saying, yeah, we did a little dip and then shooting right back up. Federal Reserve is in no position to continue to lower interest rates right now. Given that, how does this affect the consumer? Well, costs are higher, broadly speaking, are higher across the board. Car loans, credit cards, mortgages, student loans to some extent, those won't get paid for if you're taking out loans for some period of time. So these are broad costs that the consumer with finite incomes are going to have to spend their money on versus lower interest rates, extremely low interest rates, which we had previous couple of years, which caused the inflation to begin with. Given that kind of environment, the Federal Reserve has to deal with inflation first and foremost. But then we get the tariffs, which will push prices even higher. So the Federal Reserve at this point is now kind of stuck. On the one hand, there will be price pressures and the Federal Reserve can't lower interest rates. On the other hand, the tariffs may actually help out the Federal Reserve. One of the reasons why we're seeing an uptick in inflation is because the economy is expanding rapidly, even though the Federal Reserve had pushed interest rates as much as they did. It's sort of reinvigorating itself. But the tariffs come in and they take money out of the system, money that would have been circulating within the system, the economy, and creating more and more money through fractional banking. Now, all of a sudden, there's a sort of speed bump where the federal government reaches in and takes money out, pays off the deficit, which would potentially help the deficit, but unfortunately, we're going to see lower growth rates, which would increase the deficit. That could push longer yields higher. I don't know what the budget's going to look like. It keeps changing by the hour. Given that, retailers, you're dealing with consumers who have finite incomes who are having to spend more money on interest rates and the product themselves, which means, broadly speaking, retailers themselves are going to do less good. We'll leave it at that. They already performed subpar to begin with. Now they're going to be performing worse than subpar. So when I look at XRT ETF, I think this is easy money. My strategy often is to do what's called a risk reversal. Risk reversal. This is where I'll step in. I very likely will be eyeing up, say, 81.5, 82 calls, 3, 6, 9, 12 months out. I'll sell those large. I'll buy puts underneath, maybe 75s, 72 halves. Same time frame. So I'll be bringing in premium because I don't see these highs hitting ever again for some period of time. Next 12 months, no. We're going to see a lower stock market, a restricting economy, higher interest rates, high tariffs, high deficits. The stock market's moving lower. XRT moves lower. So I'll sell those calls, bring in premium, and then I'll buy those puts to take advantage of the price movements downward. Now, XRT ETF. I'll pause it here for just a brief moment. Go ahead and take a screenshot or go to Spider Select Sectors ETF list. You can see the holdings. These are the holdings. There's two more holdings. Cash and treasuries would be the other two holdings. But these are all the main companies in here. And I mean, some of these are Target, Ulta, Etsy, Foot Locker, Victoria's Secret. You get the picture. Retailers. Go to the mall. Somebody's on this list. How well are those malls going to do? They will perform less than they did previously. XRT ETF underperformed. So you start looking at the math, you start seeing how the economy is going to hit a speed bump, then slow down. The stock market will fall because the economy is restricting from higher interest rates and tariffs and deficits. Moving forward, these are your three variables when you're looking at XRT ETF that you need to start considering and how this affects the economy and by extension, what will happen in the stock market based on this, and who will perform the worst. Retailers, as far as I can see, are going to be one of those targets that are going to get hit the hardest. Again, inflation is here. The Federal Reserve is in no position currently to lower interest rates. We just saw the CPI data point move back up above 3% year over year. So the Federal Reserve is at this point stuck. We just got minutes from the meeting. That was from the meeting before CPI hit 3%. So even the minutes are obsolete. Then we get tariffs. This will push prices higher for anything imported from China. Think retailers immediately. All those products, all the clothing, that's what's going to get hit. The mall, basically. What's left of the mall. XRT ETF takes that hit. Interest rates will remain higher for longer. Because of that, we're going to see slower growth rates. Walmart stocks sold off this morning, and that is simply because of what the economy is going to see in the future. Investors this is a reality check, a wake-up call to the stock market that the future is not bright at all when Walmart, of all people, says, yeah, our customers are tapped out. And the future isn't nearly as bright. Then you look at all these retailers that aren't doing as well. For me, XRT ETF, that's an easy sell. Now, I am buying into other stocks. One of the things I am talking about that anybody who's following me for any period of time, of course, is my bond trades. I'm buying bonds because the stock market itself is going to take a hit. In this chart, I'm showing you sort of the underperformance of XRT ETF versus the stock market itself. This is the S&P 500 SPY ETF specifically versus XRT ETF. They're both spider. And as you can see, little less than 0.5% or half of performance level over a longer period of time. This goes back to 2022. For those of you who've been following me for any period of time, TLT is what I'm going long term. I've got a couple videos up there on TLT. Make sure to check those out. I've got this one is one that I continuously put out. Been trying to put out at least 2 videos per month. And I look at the economy broadly speaking. The stock market itself will sell off. What's going to happen? People are going to exit the stock market. Savvy money is going to get out and rush into bonds, which will keep the long end of the yield curve supported, which means interest rates may drift slightly higher from here, but over the long period of time, long-term interest rates will move lower, especially when the Federal Reserve is done with the inflation spikes, and from there can start lowering interest rates, dealing with unemployment, which will move higher, as well as economic growth, which is moving lower. That means my TLT ETF trades move up. That's what I'm buying, heavy. Make sure to hit the like and follow button. We'll see you in the next video.